5, 4, 3, 2, 1. Start. Banking operations refer to the various activities carried out by banks to provide financial services to individuals, businesses, and governments. These activities involve the handling of money, the provision of loans, the acceptance of deposits, and the management of payments. A bank acts as a financial intermediary that connects those who have surplus funds with those who are in need of funds. Through this process, banks contribute to the smooth functioning of the economy by facilitating financial transactions and promoting savings and investments. One of the primary functions of banking operations is the acceptance of deposits from customers. People deposit their money into savings accounts, current accounts, and fixed deposit accounts. This provides individuals and businesses with a safe place to store their money while also earning some return in the form of interest. For the bank, these deposits form the basis of their lending capacity. The amount deposited by customers is used by the bank to provide loans to others, thereby earning income through the interest charged on such loans. Another important aspect of banking operations is lending. Banks provide loans to individuals, businesses, and governments for various purposes. Individuals may borrow for personal needs such as buying a house, a vehicle, or funding education. Businesses may borrow to expand operations, buy equipment, or manage day-to-day expenses. Governments borrow for development projects and to manage fiscal deficits. When providing loans, banks evaluate the creditworthiness of the borrower to ensure that the money lent will be repaid. This is done by examining the borrower's income, financial history, and other relevant factors. Banking operations also include the provision of payment and settlement services. Banks facilitate the transfer of funds between individuals and organizations through various means such as checks, demand drafts, online transfers, and mobile banking platforms. These services make it possible for people to carry out transactions efficiently and securely. Payment systems are essential for the functioning of the modern economy, as they enable the exchange of goods and services without the need for physical cash in every transaction. Managing the flow of cash is another essential component of banking operations. Banks ensure that cash is available to customers when they need it. This involves maintaining adequate cash reserves and operating a network of automated teller machines and branches. Cash management also includes the collection and transportation of physical currency between branches and central offices. It requires planning and coordination to ensure that cash is available in different locations as per demand, without holding excessive idle money. Risk management is a crucial part of banking operations. Banks face a variety of risks such as credit risk, market risk, liquidity risk, and operational risk. Credit risk arises when borrowers fail to repay loans. Market risk involves losses due to changes in interest rates or market prices. Liquidity risk is the possibility that a bank may not have enough liquid assets to meet its short-term obligations. Operational risk refers to losses due to failures in internal processes, systems, or external events. To manage these risks, banks adopt various strategies including diversification of assets, setting limits on exposures, and maintaining capital adequacy as required by regulatory authorities. Customer service forms a fundamental part of banking operations. Banks aim to provide convenient and reliable services to their customers. This involves not only handling transactions efficiently but also addressing customer concerns, providing financial advice, and introducing new products tailored to customer needs. With the advancement of technology, banks have adopted digital channels to improve customer experience. Internet banking, mobile banking applications, and customer service through chat platforms have become common. Technology plays a significant role in modern banking operations. The use of computers, software systems, and communication networks has transformed the way banks operate. Core banking systems allow banks to offer real-time services across multiple branches and locations. Automation helps in reducing manual work, minimizing errors, and improving efficiency. Cybersecurity has also become an important area of focus as banks handle sensitive customer information and financial data. Ensuring data protection and preventing unauthorized access are priorities in the digital banking environment. Compliance and regulatory adherence are also central to banking operations. Banks operate under the supervision of regulatory authorities that set guidelines to ensure the stability and integrity of the financial system. These regulations cover areas such as capital adequacy, lending practices, anti-money laundering measures, and customer identification procedures. Compliance involves monitoring operations, reporting to authorities, and implementing internal controls to adhere to legal and regulatory requirements. Non-compliance can result in penalties, loss of reputation, and restrictions on business operations. Banks also engage in investment activities as part of their operations. They invest in government securities, corporate bonds, and other financial instruments to generate income. These investments must be managed carefully to balance returns with risk. Portfolio management is a specialized function within banks that involves selecting the right mix of assets to meet investment objectives. This contributes to the overall profitability of the bank while ensuring financial stability. In addition to traditional banking services, many banks also offer insurance and wealth management services. These services are designed to meet the financial planning needs of customers. Insurance services include the sale of life, health, and general insurance products. Wealth management involves offering investment advice, estate planning, and portfolio management services to high-net-worth individuals. By offering a wide range of financial products, banks aim to become one-stop financial service providers for their customers. Banking operations are supported by various departments and personnel who perform specialized functions. These include the Credit Department, Operations Department, Treasury Department, Audit Department, and Customer Service Department. Each department works in coordination with others to ensure smooth and efficient operations. Staff are trained regularly to keep up with changes in regulations, technology, and customer expectations. Internal audits and control mechanisms are vital to ensure that banking operations are conducted properly. Internal audits help in identifying weaknesses in processes, detecting fraud, and ensuring compliance with policies. Control mechanisms include segregation of duties, approval hierarchies, and system-based checks. These help in preventing errors and reducing operational risks. Stop.